Welcome back to the Pro Ticker Podcast, your Wednesday morning edition covering major financial magazine headlines, everyone.
Good to be back.
Today is Wednesday, February 18th, 2026. And I have to say, I spent my morning just staring at two numbers on my screen, trying to, make them fit together. I feel like we're in one of those moments that historians are going to be writing about for decades.
It definitely feels like a morning for the history books. So what are the two numbers that have you stumped?
It's the spread, the psychological spread. On one hand, you have the Dow Jones breaking 50,000. I mean, 50,000. I remember when 20,000 felt impossibly high. It's a party.
Right.
But then you just toggle one window over and you see the World Uncertainty Index, the WUI, at an all-time high, 106,862.
And we should probably put that number in perspective because 106,000 just sounds like an abstract figure. That is higher than the readings during the 2008 financial crash, the peak of COVID, and the aftermath of 9/11 combined.
That's the part I can't get my head around. Usually when uncertainty spikes like that, worse than '08 markets crater. People run for the hills. But right now, the stock market is partying, while the risk gauges are flashing bright red.
And that is the paradox. That's the central tension we really need to dig into today. The global financial and strategic outlook is calling it the great financial paradox of 2026.
So that's our mission for this deep dive then.
I think so. To figure out if the market is seeing something we're not, or if it's just completely delusional and about to walk off a cliff.
All right. We've got a huge stack of sources to help us. We're pulling from Barron's, The Economist, Global Banking and Finance Review, and some really interesting transcripts from CNBC and Fortune. And I think the only place to start is with the people setting the rules, the central banks.
Agreed. The Fed just wrapped up its meeting, and it was tense.
So what's the headline?
The FOMC left rates unchanged in that 3.50% to 3.75% range. Now remember, we had those 3 cuts last year in 2025, so a pause wasn't a total shock.
But it wasn't a unanimous decision, was it?
Not at all. Looking at the minutes, there's real friction. 2 members dissented, they wanted a deeper cut, and they wanted it right now.
And this brings up a term I saw in the Global Financial and Strategic Outlook that really stopped me. Waromics. It sounds like science fiction, but they're using it to describe right now.
It's a fascinating and slightly terrifying concept. Waromics describes this tightrope walk of managing inflation in an economy with 2 huge problems, high tariffs and high national debt.
Okay, break that down for us.
So here's the trap. Tariffs, they generally make things more expensive for you, the consumer. So inflation goes up. The standard playbook says the Fed should raise rates to fight that.
Right. Economics 101. Cool the economy.
But, and this is the huge catch, we have record high national debt. If the Fed hikes rates, the interest payments on the government's debt just explode. It could bankrupt the Treasury or force them to print more money, which of course causes
more inflation. So they're damned if they do, damned if they don't. Raise rates and you blow up the budget. Lower rates and you let inflation run wild.
Precisely. And that's the Waromics environment. And frankly, it's why the politics at the Fed are getting so intense right now. Jerome Powell's term is up in May. It's just a few months away. And the name being floated in The Economist is Kevin Warsh.
I remember Warsh. He was always seen as a hawk, right? Hates inflation, loves high rates.
That's the thing. The Economist is pointing out that he's been pivoting hard. He's suddenly sounding a lot more like a dove, which just so happens to align with President Trump's desire for low rates.
So the suspicion is that he's basically auditioning for the job.
That's the cynical take, yeah. And it's a huge risk. The Economist is arguing this threatens the very idea of Fed independence. If the market starts to think the Fed chair is just a political appointee keeping rates low to juice the market, well, that 50,000 Dow starts to look very fragile.
And it's not just the U.S. There's a leadership shakeup brewing in Europe, too, right? Global Banking and Finance Review is reporting Christine Lagarde might be leaving the ECB early.
She is. She's reportedly planning to step down before her term officially ends in October 2027. And this is all about politics.
It has to be about the French elections.
Exactly. They're coming up in spring 2027, and there is a very real fear of a far-right victory. So French President Emmanuel Macron wants to pick her successor while he still can, before he might lose that power. He's trying to lock in someone stable, like a Klasnod or Pablo Hernandez de Cos.
So we have instability at the top of both major central banks. Okay, let's pivot to the engine that got us to Dow 50K in the first place. Big tech. You'd think the vibes would be great, but I'm seeing a lot of fights in the analyst notes.
Fights is a good word. The phrase of the week seems to be substitution anxiety.
Substitution anxiety.
The fear of who gets disrupted. In 2024 and 25, the story was AI lifts all boats. Now, in 2026, it's AI is a zero-sum game. If someone wins, a legacy player has to lose.
And we're seeing that play out with Microsoft and Oracle this week. I mean, I saw the CNBC transcripts. Milius Research actually downgraded Microsoft,
Yeah.
Microsoft to hold.
It all comes down to the show me the money phase of AI. Milius was blunt. They said CEO Satya Nadella has lost the AI narrative. Their argument is that Microsoft is spending a fortune on CapEx for things like Copilot, but the margins are shrinking.
They're burning cash.
Burning cash for a payoff that seems to be getting pushed further and further out.
But then on the flip side, you have D.A. Davidson upgrading Oracle to a buy. Wise is their spending okay, but Microsoft's isn't.
Because of the customer. D.A. Davidson basically argues Oracle is selling the picks and shovels. They point out that OpenAI is growing at 10% a month. OpenAI is desperate for compute power, and they will buy every single server Oracle can build.
So Oracle is the landlord with a guaranteed tenant, and Microsoft is building a speculative condo?
That's a perfect analogy, and Microsoft knows this, which is why they made that huge announcement out of the India AI Impact Summit.
The $50 billion pledge.
$50 billion by 2030 to invest in infrastructure and skilling in the global south.
Wow. Shareholders usually hate that kind of spending. Why isn't the stock getting hammered on that?
Because it's a defensive moat. The developed world is saturated. The global south is where the next billion users are. By spending that money now, Microsoft is trying to lock them in before Google or a Chinese company gets there. It's about planting the flag now to harvest the data later.
Speaking of planting flags, we have to talk about Databricks. Raised $5 billion at a valuation of what, $134 billion?
An enormous valuation. But the interesting part is what the CEO, Ali Ghodsi, said.
He said they're staying private. With the Dow at 50K, why would you not go public?
Because he's afraid of the volatility.
Mm-hmm.
He explicitly told CNBC he's worried about a 2022 situation where tech stocks just collapse. So the insiders are terrified of the public markets, even as the public markets hit new highs.
Which brings us right back to the paradox. Let's move from the tech world to the media world, because things are getting very hostile. Over at Warner Bros. Discovery.
This is the takeover battle of a year. You've got two suitors. The first was Netflix. With a friendly stock-based merger, the WBD board was leaning that way.
A clean, modern media marriage.
Exactly. And then Paramount Skydance kicks down the door.
With a bag of cash.
A huge bag of cash.
Yeah.
A hostile all-cash offer at $30 a share. That's over $108 billion. And in a world this uncertain, cash is king.
And WBD had just granted them a waiver. Right, they've opened the door.
They had to. They have until February 23rd to submit a best and final offer. But there is a ticking clock. WBD has already scheduled a shareholder vote on the Netflix deal for March 20th.
So PSKY has days to get their financing in order, or WBD marries Netflix.
It is high drama.
Yeah.
But if you step back, this is all about survival. The old linear assets, CNN, HBO, the movie studios, they can't survive alone against the tech giants. This is a consolidation of desperation.
Let's pivot to something that used to be a safe haven, Bitcoin. It just dipped below $70,000.
It did. And for years, we heard Bitcoin is digital gold. It's supposed to go up when the World Uncertainty Index goes up, but it's not.
It's doing the opposite. What's going on?
Barry Bannister over at Stifel had a scathing take on this in the CNBC transcript. He says the correlation is broken. Bitcoin is no longer behaving like a hedge. It's trading like a leveraged tech stock.
So when the Nasdaq sneezes, Bitcoin catches a cold?
A bad one. Stifel is predicting a potential fall all the way to $38,000.
Wow. From 70K to 38K, that would be a bloodbath.
It would completely destroy the store of value argument.
Yeah.
And we're seeing weirdness in physical metals, too. Silver had a flash crash, down 31% in a day, even while searches for buy silver were spiking.
Which means the big institutions are selling.
Selling to raise cash. But the real-world asset story that really got my attention wasn't crypto or silver. It was the story in Barron's about cows.
It's cattle crisis, yes. This is where it gets real.
It really is. Because you can code AI, you can print money, but you can't print a cow. Barron's is reporting the U.S. cattle herd is at a 75-year low.
75 years. We have fewer cattle now than in the 1950s.
And biology has a long timeline. It takes 2 years for a heifer to mature and breed.
Yeah.
Even if ranchers started aggressively rebuilding today, we wouldn't see cheaper beef until 2028 or 2029.
So steak and burgers are actually becoming luxury items. And this is that sticky, real-world inflation the Fed can't do anything about.
Exactly. Higher rates don't make cows grow faster. And all of this is happening under this cloud of geopolitics. Let's touch on that. We have updates from the Ukraine talks in Geneva.
What's the latest there?
It's mixed, Zelensky is accusing Russia of dragging out negotiations. There's some minor progress on practical stuff, but no breakthrough on a real peace deal.
And then there's a report from United 24 on Iran.
This is deeply concerning. The intelligence suggests Iran now has enough enriched uranium for about a dozen bombs. But the new fear is that they might move that stockpile to Russia.
And if that happens?
It completely changes the game. It rewires global security, and that all just feeds right back into that World Uncertainty Index number we started with.
It's a feedback loop. And you're seeing corporations react. Gemini, the crypto exchange, they're clearing out their C-suite to get ready for a regulatory war with the CFTC.
Or look at Western Digital. They just sold a $3.17 billion stake in SanDisk. Why? To pay down debt. Smart companies are de-risking. They're cleaning up the balance sheet to survive a potential storm.
And yet, amid all this, Fortune releases its world's most admired companies list, and Fujitsu is on it for the 8th straight year.
In a world of chaos, being boring and reliable is a superpower.
Okay, let's try to pull this all together. Dow 50K, WUI at a record high, central bank leadership in flux, a capital war in AI, a scarcity crisis in food, a nuclear threat on the table.
It is a lot.
So what's the big takeaway here? How can all of this be true at the same time?
I think it goes back to that word, paradox. The markets are betting on waromics. They see the government spending, the AI productivity, and they see nominal growth. But the uncertainty index is looking at the structural risks, the broken supply chains, the political vacuums, the chance of real conflict.
So the stock market is saying, we'll make more money, and the uncertainty index is saying, yeah, but the world might be on fire and the money might be worthless.
That's a good way to put it. And here's the final thought I'd leave everyone with. If the WUI is correct, if the risk is truly higher than 2008 and 9/11 combined, why isn't the market crashing? Is it because our economy is just that resilient? Or is it because there's so much liquidity sloshing around that investors are just blindfolding themselves and buying stocks because there's nowhere else to put their money?
Are we resilient, or are we just trapped in the casino because the doors are locked?
That is the question. Because if we're resilient, Dow 50K is just the beginning. But if we're trapped, well, the exit is going to get very crowded when the music finally stops.
A sobering thought, but a necessary one. We will be watching that WUI number just as closely as the Dow from now on.
Absolutely.
We'll see you all tomorrow morning with new headlines from major financial magazines.